you have a gross effective rental income of right around $1 million. This is my favorite strategy in storage, and so we got a great deal breakdown. Welcome everybody to Self-Storage Income, and we are going through a self-storage deal that we are currently buying. We have it under contract. We've done multiple deals this year, and we are targeting by the end of this year another about $100 million in assets. So we're running around here. We're hiring. It is really busy. And I wanted to do an actual look and a deal breakdown for everybody to say, what do certain types of deals look like? What are we targeting? Mm-hmm. And I think it's important to know that although today for people listening or watching this, it looks like our firm, right? I think sometimes it can seem too far off. You know what I mean? It's just like you have all these employees, you're buying these big deals. I can't relate. Mm-hmm. Our model, though, that we're doing has fundamentally not changed. The amount of deals and transaction has. How we go about it has improved over the last 2 decades with technology, but it's still the same things that everybody else does and can have access to.
Yeah, it's the same fundamentals that you're going to be looking at today, right now, looking at small deals, looking at big deals.
And this is a deal that most people would buy. We're looking at today. In fact, this deal strategy we did on Hayden. Mm-hmm. So this exact strategy we did on Hayden, we did it on a couple other deals from 10, 15 years ago. Mm-hmm. So this is my favorite strategy in storage.
Oh, dude.
And so we got a great deal breakdown.
It's, just touching on that, this deal, it's an amazing deal. I talk about this all the time because people are like, oh man, do I acquire, or do I go and do I build something new, or do this, do that? And it's like, yes, do both. Yes. Go and find something that has expansion potential. You get the benefits of buying an existing business, cash flowing asset, and being able to improve value through operations, do your whole value add strategy there. But then you also have that opportunity to go in and develop at the same time. And you have that massive equity creation and value creation. It's just this amazing molding of cash flow and wealth all in one, and being able to, it's like, getting your cake and eating it too kind of a scenario.
Yes. And what I like about our expansion strategy, which is essentially we're buying an existing asset like we would buy any other asset. Mm-hmm. We're looking at all the things, and we'll go over it, how we look at it, what we're trying to see and find. It just happens to come with extra land. What that does then is it provides us that opportunity to, like Connor said, to add more. Why that's so beneficial is outside the cost of build, the expenses are already covered under the asset that we purchased, and the NOI is already attributed to that expense load and current revenue. So outside the cost of build, that all goes to your NOI, which that's how we get value, is by net income in commercial real estate.
Yeah, you're not trying to float something for 2 years while you're building it, and you're, that's development's no joke. It's doable. It's amazing. There's deals out there, but yeah, if you're especially just getting started, if you can find a deal that gives you that cash flow, that gives you that ability to learn the business, to value add, to do that as
you grow,
man. It's amazing.
It pays off in dividends, and it's that lower risk. Connor said it perfect. Have your cake and eat it too. That's why we love it. I do want to mention here, as we're getting into it, everybody, we have our self-storage income event the 16th through 19th of September.
Coming up fast, dude.
That's right. We actually had to move from Coeur d'Alene to Bend, Oregon, because we maxed out last time the resort. Now, this is not a event where we want thousands of people. That's not how it's held. It's specifically held in the Northwest in these towns like Coeur d'Alene or Bend, Oregon, to allow a much more intimate setting where we're not here to do a sales, a pitch fest. No, that's not what this is about. This is in-depth, open analysis by actual people in the industry that are doing this. It's all storage. This is a boot camp plus some with all the professionals. Our sponsors. I do that in air quotation because the main sponsorship, they're just our ecosystem of companies. So we're all here to share industry data, what's happening. Our speakers that are there are people that just started, like they just got their first deal, to people that have grown over the last few years, to people that have been in this industry since the 70s that are experts. We've got, people that have hundreds of millions to people that have one as speakers and participants. And then of course we have lots of people that are just looking, that are attending to get into the industry. But this is not it's hard to even compare this to a normal event. Everybody that's been to our Coeur d'Alene event knows this is we're paying for the food. This is activities. This is high end. We're doing this as a brand community building. So self-storage income, people are coming. It is the best event in self-storage. It is the nicest.
Oh, the premier event. Dude,
this is not like Vegas style events.
No.
And it's cheaper by a lot than those. Yet what you get is leaps and bounds. We're all in the same room. You guys are going to be there with me,
having breakfast together, hanging out, having lunch, dinners, all that stuff.
Activities, when we're on the river, we're on the lake, we do fireworks. This is meant to be a premium network with premium people.
Well, man, you always hear about that degrees of separation and proximity and surrounding yourself with like-minded people and all these different things. And this whole thing, it zeroes down those degrees. You're sitting across the table from, again, these people who might have started in the 70s and have had assets through all the cycles, the ups and downs, that have all the experience in the world. You might have somebody who just bought, who just went through this lending process with a bank or did this or did that like you're looking to do right now. The amount of connections and problems that you can solve in those rooms, at those breakfasts, at those speaking sessions, all of those things, the insights, all of it, it's just totally invaluable. And again, 100%, like hands down, the most premier self-storage event that has ever been.
Yeah, it's a blast. We look forward to it for the full year. This is for, what we wanted out of an industry event. This was what, not about this event. We're not an event business, right? That's not what we do. It's not about making money. It is literally about reinforcing our partners in it, like Store Local and Tenant, which are our sister companies. We put time, effort into this thing. This is our favorite time of year. It's like our Christmas.
It's just about getting out and providing value, man.
Yep. So everybody follow the link below. Make sure you're there. Come and join us. We'd love to have you, whether you own a portfolio or whether you're looking to get into storage. Come join us, and you will be so overwhelmed by storage information. You may be sick of storage by the time you're done, because we all just love this so much.
Exactly. Yes. Follow the link, and caveat, we said Bend, Oregon. Know that it's just outside of Bend, Oregon, in a resort town. It's just absolutely incredible resort. So don't think we're going to be hanging out in Bend, Oregon, and you're like, what's Bend all about?
No, it's awesome. So I want to dive into this example here, Connor. We want to be open about these numbers and talk to you guys about what we're doing, because that's how we learn through, actual hands-on. This is real time, meaning we're buying this now. This isn't a deal we've done in the past. So we're showing you in today's market what we're doing, what we're looking at, most importantly, why this deal, what stood out to us. We look at lots of deals right now.
A quick note on that, man. I was talking to Quinn about this a couple weeks ago. And because there's been people that, they get frustrated. They underwrite a few deals. They submit some LOIs. And they're like, dude, I'm not getting anywhere. I've submitted like 3 LOIs and nobody's responded. And everybody's saying that, no. We're literally looking at like 100 deals a week and submitting, a ton of LOIs per week.
Yeah.
It's not, so just, that's part of the game. You're not doing anything wrong. Keep doing what you're doing. Get those reps in. Yeah. Don't give up.
Yeah. You want to buy, and we're buying lots of deals. I mean, if you're putting that work in, the deals, they're there. They're out there.
100%.
And they're really, really good deals. But this is a market to where you need to understand value and you don't want to make mistakes. All right, Connor, let's jump into this here.
Let's talk highlights, man. I mean, first and foremost, we just did a podcast recently talking about like the one thing, man, and that's demand. So let's talk about like market conditions and why this deal is so good from a market standpoint.
There's a few things that I liked and our team really pinpointed on this area. It is a larger MSA of a market. And when I say a larger MSA, I mean, it's within, I look at markets, and a lot of people have heard me talk about this. My favorite market strategy is the Goldilocks strategy. The Goldilocks strategy, for those of us that love watching documentaries and stuff on the universe, the Goldilocks planet is a planet that is in just the right spot so that it can sustain life. Too close to the sun doesn't work, too far away. So this is what I would call a Goldilocks market. The sun acts as a big MSA, right? So that could be anything. I don't know. That could be Austin, Texas. That could be, whatever city that you take, second tier market, first tier market. As you go out of the market, the further away you get, the impact of the sun gets less, right? The MSA. So the economic impact gets less. But also the closer you get to it, you get the same effect of those hot markets where you have low cap rates, lots of competition and capital. And so I like to shoot for markets that are smaller, but they're still within the effect of those bigger MSAs. So they get still some of the economic gain of it, but yet we're not getting that overheated competition. This is one of those markets. So it has a growth rate that's doing good, like the MSA that it's close to.
Yeah.
The population within a 10 miles, about 75,000 people. 3 mile, it's right about 12. When we're looking at the overall area, the key thing that we found within this market analysis was there wasn't any new facilities that were being built close, so we had no new supply. The next thing that we really liked about it was there were clear holes, let's say, in the supply in the market. So there were products in this market that were not being offered at all. And that is a huge plus because of the expansion opportunity. So then we can expand, and we're not supplying the market with products it already has and oversupplying it. We're giving markets that products that don't exist. Right. So we'll be the only ones that have it.
Well, and like the team called out here too, is, we'll be taking through that expansion, taking it from Class B to a Class A. So you're not only diversifying your unit mix, adding the value, you're again, going back to that Goldilocks, there might not and probably isn't like high-end Class A storage in that area. So we kind of even touched on this like old blue ocean effect or concept last time in the podcast too, talking about demand and some of those things. So fantastic setup.
Low unemployment.
Yeah. Well, the growth rate is like 3% almost.
Yes.
It's bonkers.
Yep.
Love
with no new
that.
supply coming. So
yeah, it's amazing.
That's an important part for everybody. Why do we start out with that? Like Connor said, if you want to dive more in on demand, we did a whole episode. Was it the last one?
Yeah, it was the last episode. One? I don't know what order they're being released in, but
it was the last one we filmed. So, and that's the kind of end all be all. Everybody's demand. Yep. So we, especially in this market today, where nationally and overall due to interest rates, demand has softened. That means localized demand is even more sensitive. So if that's not good, we walk away. So that was the first thing that we liked about this deal. The purchase price of this one is 4.3, and we're looking at expanding. Do you want to talk about the expansion in space and units? So what we're trying to do there.
All right, everybody, quick interruption. I wanted to let you guys know about our live event, SSI Live, going on this September the 16th through the 19th. It's going to be in the beautiful location just south of Bend, Oregon at the Sun River Resort. It's an absolutely phenomenal venue for this occasion. This is the premier self-storage event of the year. You're going to be able to be there live with me, with AJ, in a small, intimate environment, and it allows you to network with some of the best minds in the self-storage industry, from operations to remote operations to closing a facility to lending to structuring deals, everything in between. You're going to be able to get a start to finish understanding of exactly how to find deals, how to put them together, how to start owning and operating a self-storage asset from start to finish. You're also going to be able to hear from individuals who have been a part of our SSI community and membership, where they started with just one facility and being able to leverage what they know to do all these amazing things for them, their families, their futures by doing exactly what you're doing, listening to the podcast, coming to these events, being a part of this community. They even have some incredible activities that we can participate in while we're there. It's going to be anything from volcanic hiking to floating to horseback riding. There's all kinds of amazing opportunities to get outside of just the sessions, connect with other individuals at the event, because that's what it's all about. Bringing people together, building those relationships, being able to put deals together to fund them. So take a minute, click the link in the show notes below, go register, get your spot secured, and then of course, come back to the podcast. Yeah, we've got the 4.3 purchase price, and there's a $2.3 million construction budget, which is awesome. Looks like equity raise on this one is $3 million as well. So that's great. So right now, square footage wise, the facility is sitting just around 50,000 square feet. The expansion is going to take that total square footage, that net rentable square footage, to 66,000. So almost 70,000 square feet, almost doubling the facility, which is pretty legit. And then going back to that, when you're expanding, identifying, again, the most high demand units, being able to build those out as you're developing is fantastic, because you can fill a need. You're not having to try to fill units that people don't want. Some of those things that can be hard in those markets where those specific unit types get hit hard with some of the market changes that you see. So total number of units right now is 369, and that expansion is going to bring that total unit count to 594 spaces total, which is fantastic, man. That's going to be a huge expansion. Again, almost doubling the facility, which is going to do a lot of incredible things and allow us to achieve some really fantastic returns. So
now, when we bought it, we're buying it without the need for expansion, as in
it works without it.
It works without it.
Yes.
So the expansion, it can't be, this doesn't work unless we do the expansion, right? That's not how we want to go about it. Our going in cap rate on this is 7.7. So the purchase price per square foot is $66. There are things that we will do to improve the asset, but that going in cap rate is really good. So looking at that, our expense margin is good. We're talking about 1 year expense margin 45%, but we have a break even in 1 year of 77. So we have a good solid asset that we're buying at a great price, that when we look at this, we're saying without the expansion, this is good. It's worth it. We would buy it.
Yep.
So we're going into it without an expansion. There's still room to improve this asset. We would improve it by, first and foremost, upgrading some things. So we would upgrade, in general, the quality of the asset is really well. So we're not looking at this deal like this is a dump that needs a lot of huge CapEx. No, it's a good solid build. Low CapEx on that point. Where we want to put any extra money and to improve it will be on the technology side. We're talking keyless technology,
that operation
value, the maybe some better camera systems, and improving those things that the customers interface with, they act with, that help and improve them.
I love deals like this, man, because there's so many times that it feels like a lot of times that there aren't deals out there like this. And the fact that we're sitting here looking at a deal that is like this is so freaking exciting. They're out there. Keep looking. Because going in and finding a facility that's not super run down, doesn't need a ton of CapEx, you can go in and just, all you have to do is answer the phone and do a little marketing maybe, and make sure that there's not a bunch of weeds growing, and people can pay and rent and do all that stuff online, like super basic of the basic stuff. And the amount of value that you can create in such a short amount of time with a minimal amount of effort. Again, it's hard work. It takes time.
Yeah.
But a lot less than trying to, do CapEx,
Yes.
massive turnaround projects and all that stuff on top of it.
Which also can increase
amazing.
risk.
Yeah.
Because you don't really know when you start to get into that stuff.
Oh, for sure.
Which can be a lot harder to target that going in number. The owners of this asset and facility, they did a great job. It looks nice. They've taken care of it. They've done it, which gives them that value.
This isn't the first one of these we've done either. I mean,
No.
we've done a number of these where you go in and it's a solid asset. Like it's like physically speaking, from a maintenance standpoint,
Class B.
things are great. Yeah.
And so when we look at this, the downsides to this that we would originally look at was, first of all, the size. So the size without the expansion would probably be something that, we would want more units. We'd want it to be a little bigger. So without the expansion, this would probably be a little under, as far as total size go, what we would generally target. But that, as far as it goes, it's great. The cash flow, all that. So we're fine with that. That's why the rest, this add-on, really takes it to where we want it. The difference is big. We have a purchase price going into this thing at 4.3. When we add in our total construction budget, we have a loan that we're going to need to put in it. We have an all-in and cost of this of right around 7.1 million. That's about a 55 to 60% leverage with the debt that we have. So it's low debt, but it's a good, solid project. But a huge cost, obviously, is that expansion, right? We need that capital, and we're taking that capital right out of the gate. Sometimes with expansions, you may not do that. That's how we did a few of our other ones. In fact, Hayden was a perfect example of that. We bought it. We knew there was expansion, but we waited. We didn't do it for a couple of years.
Yeah, Hayden, Nampa, both
of those.
Yeah.
Yep, you're exactly. Middleton Road.
Yeah.
We didn't. There's the reason why at Nampa's 5 years. The reason why is operating it gives you a really good look at the market to understand which types of units have higher demand. And so you can build the correct units that are going to give you the highest revenue per square foot and are going to fill up the fastest, that have the most demand. And when you're operating it and owning it through different busy season cycles, you have an intimate knowledge of that. I have 100%. A waiting list. I know this many people this month ask for this type of unit or this type of unit nobody asked for, so you don't want to build it. Why then aren't we doing that with this one? Because the type of units we are building, which is climate controlled, does not exist in this market. So we know demand is there, but there's no product at all. That's not something we're going to learn, by owning to have not a product. That's a great opportunity for us. So instead, we want to get it done quickly. We want to get it done fast. So as we close the loan, we're putting it all together. That allows the asset cash flow to help pay for that building and construction. So we're not going out of pocket, or we're not risking, like you mentioned before. If you have a development, you have the time to develop it. You have the cost associated with that, but then you also have to fill that asset up.
Yeah, the
so
lease
you have
up.
lease ups, which that could be years, right? It will be years, right? I mean, in 2 years, that's amazing. So traditionally 3 years. Bad would be 4, 5, obviously. But there's operational expenditures and costs that if you're not full, you got to fill up. We don't really have that here because we're using that cash flow. Once it's open all the way, if you never fill up, obviously that's a different story. But we have cash flow coming in to pay the bills.
Man,
that makes all the difference.
When you don't, those bank accounts They get small really fast, man.
Really, really fast. Cash flow going out and not coming in. That gets brutal. That puts a lot of stress on you. So that's something we plan for. When we develop, we have a lot of cash sitting in the bank account to pay for operations for years.
Definitely.
Because we're like, we won't fill up. Even if we believe we'd fill up in a year.
Yeah.
No, we do a 3-year plan.
Yep.
We need to have that capital. I don't know what will happen in the future.
Exactly.
We need to have something to rely on. So if markets slow down and that fill up rate is twice, I don't think anybody should ever plan on filling up a facility in under 3 years.
No.
That's not smart.
Well, dude, even at this point in the game, I don't think we've ever had a facility take 3 years to fill up.
I don't think we've ever had anything over. So right now, I mean, we're coming up on a year on
Curtis.
Even Curtis. Yeah, and I mean, even that's
close to 70.
Close to, I think we're over.
Is it over 70?
Yeah.
Yeah.
So, I mean, within the first 12, 13, 14 months, we will be at, 80% occupied, which is incredible. In this market,
it's insane.
That was, we're lucky we had a good spot. But it would be silly for us to plan on
Absolutely. That. Yep, exactly.
So why don't we talk about how we see this in cash flow? We talk about building cost. We talk about acquisition. We have our CapEx at the front. We're improving technology. Then we want to be able to maximize occupancy through marketing. And we want to be able to use that excess demand to be able to lift rates, to be able to get the best, highest yielding customers we can. So with the expansion and everything, how does that look? So what I wanted to do here is kind of break this down. Let's take a look here, year by year, and then how something like that translates into returns, or what would our expectations be? First and foremost, the rental income. Year one, we have a rental income right about $562,000, right? But once we include ancillary income and other fees, our effective gross income is $622,000. Obviously, you have discounts and bad debt that can take out a big chunk of that. So rental income's coming in at $562,000. Our expenses are right at $277,000, which gives us a net operating income of $345,000. That is before debt. So that's before debt. We're looking, once again, project level. That's a yield on cost of right about 5 and a debt service coverage of 1.19. Over the next 3 years, we see a fairly substantial jump through operations and optimizing things like bad debt discounts, rental rates, vacancies that we clean up, which brings our year two rental income up $638,000. So we would want, $50,000 roughly increase, something around there. We're trying to lift up year two. That brings up the net income from $345,000 to $408,000. That's a big jump. Because you have to remember that the expense load and ratio isn't really changing. All the improvements go down to the NOI. That takes our yield on cost up to 5.8. Now, we see to year 5, we see really, really big jumps in the rental income. That is due to the lease up and stabilizing of that expansion. So year 4, so we jump past year 3 and go to year 4, we're at over $850,000. And then year 5, upon a stabilized asset, we're giving it 5 years, you have a gross effective rental income of right around $1 million. The net rental income that we'd be looking at is right $939,000, and our expenses obviously have risen during that time. So it goes from $277,000 worth of expenses to $387,000, giving us a net income of $628,000. So the difference on net operating income there from $345,000 to $628,000, that gives us a yield on cost of right about 9%. debt service coverage is right about 1.2x. Now, this is where really the magic happens. We're talking about a yield on cost going from 4.9 to basically 9. And this is being conservative. So we are giving us a lot of time here. We're talking 5 years. We're really building this out. We're slowly optimizing rental income. We're not giving ourselves huge jumps. I mean, ancillary income, we're not even moving the first 2 years at all.
I was going to say, I love how incremental this is, because even for us, I think it's easy for us to look at this and say, hey, we can look at like a good, better, best scenario. And almost always, like this really conservative look, we're like, yeah, it's probably going to be way more than that.
Yes.
Like things are going to look way better than that is actually, what we're actually underwriting, which is great. But showing this in your underwriting is really, really important. Showing those good incremental, steady changes. There's no huge swings to this, to that. Like there's going to be some kind of silver bullet you're going to shoot, and things are going to be rainbows and sunshine. Like this good, slow, incremental growth over 5 years.
We're working for it. We're making it happen.
Yep.
And it's important to realize that for our first years, we do not count any change in markets. So why that's important, because there is an idea that I think a lot of people in real estate, they like buy an asset and then they underwrite, rents in the market are going to grow every year. Yeah. We do not build that in. So we are looking at what we call money on the table. And I talk about this in the books, obviously, our communities, we talk about this and build this out. But that is what's there today. And the improvements in that NOI from year 1 to year 2, we're talking about improvements that are measurable and exist today without the market changing anything. We're not
working
saying
from the knowns.
Yeah, we're not saying it's just we can get rid of a bad debt. We can tighten up our discounts. We have our economic versus physical occupancy that we can take care of. We're not saying more demand's going to come in. We're not saying rental rates are going to go up. It isn't till like after year 3 that we would even start to plan on saying, okay, after years, market rental rates, we have no new supply, should start to go up. And even at that, we're at like inflation. So
3% or
which,
so.
If you take the years that we haven't done it, our average then becomes, way less. The point is, we're not expecting the market to make us.
Yep.
This is very slow, incremental. If the market was strong, you had interest rates that dropped and demand, this would be a much different picture. And that's traditionally what we've seen. The problem is there are times when that goes the other way, like we've seen over the last 3 years, where this effective gross income drops because market rates are dropping and demand's dropping. So then you have a struggle of trying to optimize the asset through occupancy and rates in a market where the actual asking of the rate, that street rate, is dropping. We got hammered on a few of our assets because we had market rates where the rates dropped 60%, $200 to $60 in a market when we were in fill up.
Yeah, trying to lease up.
Now you're going into it, you're underwriting your building. To put that into perspective, that market hadn't seen that rate under 150 for years, and definitely not under 100. So it was so unforeseen that, because even as storage, if you look at the Great Recession, we never had rental rates that dropped like they did over the last 3 years. The reason being is, and I have this in some great information we've shown and on YouTube videos, things here, but the occupancy, as it dropped during the Great Recession, rates remained fairly stable. People dropped them, of course, but there was the idea that I'm not going to go just slash rates because then I'm stuck with a customer at this lower rate. So occupancy went down, but rates remained stable. What we saw in this cycle over the last 3 years was the inverse of that. We saw occupancy remain more stable, but rates dropped. So in the Great Recession, occupancy went down to like 60 to 70%, but rates only went down by we're talking like street rates down 9%, 10%. This time, occupancies generally stayed even nationwide around 90%, but rates, even in 1 year, in the Wall Street Journal talking about it, dropped 20%, and that was across the nation. Mm-hmm. And so some places got hit hard. Why that's important? When you plan out the market, you don't know what it'll do. So the assumption of market given rate increases may not happen, but it may go the opposite way.
Yeah, then you're really in trouble.
Then you're really in trouble because it's the spread. So we don't want to be doing that. That's the same thing with assumptions on like interest rates. Oh, interest rates are magically going to drop down to 4%. No, we don't assume that. Market given returns also come in the fact that we build in a sell and somebody's going to just buy this for some great, amazing price, right? We also don't do that. So you want it to be measurable, known in today's environment, which a lot of those metrics aren't good. High interest rates, right? You have higher cap rates. That makes for an amazing buy though. If the market changes and does those things, that makes this amazing buy be a rock star.
Yep.
And that's great. We obviously hope that happens, but we do not want to be underwriting for those things because those swings, we just don't know. Luckily for us in that cycle period, we're on the opposite side, isn't we're now buying facilities at this lower basis, higher interest rates. How that translates now into our returns, when we're looking at our project returns, we focus a lot on this yield on cost. Why do we focus on yield on cost? Everything else being equal, if your yield on cost hits a certain level, no matter what a lot of the markets do, you have options. We can refinance, you could sell, you have huge cash flow, and you have huge amounts of equity, even if that equity is changing. So we're not saying that its value is in year 1, 2, 3 going up. We're saying the yield that we're getting predicated on the total cost that we bought it. What was everything it took, all the money we spent? And then how does that yield that we're getting from what we bought change? Fundamentals. That yield on cost changes a lot.
How does that differ from the IRR? Because we've got like that targeted, 19% plus IRR. Those two metrics are great to look at, but how do we look at those differently?
Okay, so IRRs, I dislike greatly IRRs. And there's a few reasons why. Generally speaking, we literally have to show the IRRs and OMs because that's how people compare a lot of deals out on the marketplace. But the reason why we don't look at that on a project-based level and we don't look at that on a returns level is due to the fact that IRRs can be so easily manipulated. So let's use, for an example, an IRR is predicated on your return, but also how much it's weighted in time. You could have a total return over a 5-year period of time that's the same, but depending on when you get that return, changes the IRR. So it can look way better, even though your total return isn't. And there's things that you can do to manipulate that to make it look better, which I don't like.
Yep.
And a lot of people got in trouble and continue to get in trouble because they're so focused on just giving cash back, especially quickly. They either raise more than they need to give back. Right. And so they're just taking money and giving it back so they can show returns in that first year because that boosts that IRR.
A lot of that going on a few years ago.
A lot of that going on. And then when that ends, that's very abrupt and people start asking questions. But it also then says, well, let's move our CapEx later on down the road because we don't want those expenditures hitting now. I don't like that. Because we should be improving the property so we can be competitive in a marketplace.
Yeah.
Because what happens, you put that off too long and rates go down, then you can't afford those improvements, and then it becomes a downward cycle. And that's scary. So when we're looking at our yield on cost and then our cash on cash, we do not predict any prior to 3 years on the cash on cash. We don't look at that because we're expanding. The yield on cost goes from right about that 4.7 right up to that 8.5 to 9. Our golden yield, what we're targeting, is a 8 to 10 yield on cost. That puts us in year 3, 4, and 5 on a cash on cash 5% or 4.55% cash on cash, then 120% cash on cash in year 4, and in year 5, 9 to 10. Why?
Good old year 4.
Yeah, why did 4
Yep.
get that? The reason why, and we actually project a higher yield on cost in year 4. So there's a big jump from year 1, 2 to year 4. What happens is after we've built that asset and we fill it up, the cash flow is now very disproportionate to our cost and our purchase price. That means our value of our asset has gone up a lot and disproportionate to what our return is. So we look at this as a return on equity.
Yeah.
What's the asset worth and what are we making? That return on equity in year 4 goes down because the value's gone up so much. So instead we refinance, get that value out. Why would we want to do that? First of all, people may say, oh, it's just taking on more debt. No, not necessarily, because you're taking on the same amount. So year 1, we have 60% debt. Year 4, after the refinance, we still have 60% debt.
Right.
It's the same exact level. We just improved cash flow up, right? That means then too, in year 4, that return that comes back to us in that refinance is tax-free. If we sold it, you'd have to recoup depreciation and pay taxes, which is, whew,
Not fun.
oh man, that takes your return way down. So that is a perfect vehicle for us to do that. Even after that refinance, we're looking at cash on cash of 9+%. So we went from almost a year 4, a 9 yield on cost, down to more like an 8.5. We're still improving the asset after that, but that's why that yield on cost changed. Why? Because we took on the debt back up to 60%, so we have to pay it. But at the end of the day now, we have an asset we can sell and it's still worth a lot of money. So we can recapture those created returns. And we have low risk because that cash flow of an existing asset's paying it. We have a huge jump in our yield on cost and our cash flow, especially predicated on what it was worth and how much we bought it, that we can take out in a sale or debt. So let's say that refinance isn't a good option and we want the money back. We could go to the market, and the amount of equity and that yield on cost is so high, even with cap rates changing, we're going to get our money back. And that's what we are looking for, like, even if things don't go our way, right? So it's a conservative way to build a lot of equity and have big margins, great yield on cost, high cash on cash that gives us options for a refinance or a sell. So no matter what the market conditions are, that allows us to take advantage of those market conditions in the best way. Sometimes the market makes it so it doesn't make sense to refi,
Right.
because you can sell it at such a higher amount. Even with taxes, you're going to get more. Other times, that's not how it works. There's no buyers in the market. Cap rates may be high, but banks, how they value, their cap rates don't change to the market. They don't look at it like that. So a bank says, oh, well, we value this at a 6 cap. And then interest rates go up and markets change and people were buying at 4 caps. Now all of a sudden they're buying at 7 caps. Well, the bank's still at a 6 cap, right? They don't fluctuate nearly as much with the market. It's a stable leveling value for us to use. And so sometimes in the market, it makes more sense to refinance, take the cash out tax-free, and then sell if you want at a later date, or refinance again.
Or 1031, you know, that's
1031,
still an ability.
yep.
Hopefully that stays around for the rest of forever.
So they renewed and brought back 100% depreciation. So we were looking at this year, for example, and just took our last deal that we closed on a month ago and doing our accelerated depreciation.
Then your cost seg.
Our cost seg on that year, it's an 80%.
Yeah, that's amazing.
So on our last asset, which
Yeah.
is awesome. We don't always get that.
Another huge benefit
but
doing the expansions.
That's a huge one that we didn't have.
Yeah.
And that was on, was it Ames or another one? So that wasn't even on a new build or expansion, right? But expansions are really good because you get such high. I don't remember what the Statesman was, but it was wild.
Astronomical. Well, and that's the other thing too, because as you're going in and you're improving that cash flow and that value, being able to have that tool to offset your tax exposure when you're getting all of that new cash flow in.
Yep.
It's fantastic, man. So you're not ended up spending as much in taxes.
You know, I have a friend, Jeremy, who's an investor and partners some other deals stuff with us. And we did one of the deals that we did, we did the cost seg. And when he looked at it, he's in a high income tax bracket. And he texted me, he's like, look at my tax return, look how much I got back. He's like, I made 60% of my money from that. That alone.
So sweet.
So like that year one. And this is the thing that we
That's
like
cool.
to do, especially when you have assets that we're expanding, that tax benefit that year one, that's that real gain that you get. And then we can say, all right, year 2, 3, what are we getting? And so that moving back up and getting past this year, that's a big deal. That's real money to you.
It's a game changer, man.
It is. In fact, one of the highest ways that you can get more money and a higher return is literally just because you don't want to pay not paying taxes. I mean, that's what we're going through this year. And I mean, we were talking before this, we're going through it, like calculating how much depreciation we need. It does not matter. We are selling a handful of properties. The best way that we can make the most money in our business this year is by not paying taxes, not making money. Because we have this event that is so big, we have to pay capital gains tax, but we also have what's called recoup. We have to recoup depreciation. That means our taxes are astronomical, insane.
Yeah.
So every time we're saving tax, that's real money coming into us. And it's just a funny world to live in where you're like, it almost doesn't matter what the profitability of the company is, because we make the most money by buying properties, getting depreciation for ourselves and doing these things. That's where we're going to make all our money. But it's true. That's a real thing. There's reasons why the government has these rules. They don't want you to get the money. The rules are very simple with the government. You don't take the money. That's why 1031 exchange exists. You don't take the money. You roll it back into other properties. You keep it in the economy.
Yeah.
So you're incentivized to not get the money, but to keep it working. And the government's like, all right, if you're going to keep this working and in the economy, you're not going to take it out and buy Ferraris, everything else. Then we're going to say, all right. But if you want to take it out and play, you need to pay high taxes. So this strategy helps utilize those rules that are incentivizing you, me, everybody else to invest in the economy. And then we get to offset our income taxes for it, which is a really real return.
Yeah.
Especially there's a lot of people that are doctors, that are high income people. The returns that they make on their investment are just minimal compared to what they get an offset in their taxes. They pay $250,000 in taxes a year. So for them, that's huge for that first year. So we're very, very excited about those rule changes. And they're also really important for those of you that travel and have seen countries that do not have these kind of tax breaks for real estate investors. First of all, it would never make financial sense to ever do real estate without them because we have to pay property taxes. So the taxes that we paid on our properties were tens of millions, millions a year.
Well, I mean, it was such a big deal that, I mean, how many years did your dad spend actually putting through legislation to help change and impact this?
Yeah.
I mean, it's
3 years that legislation worked on some of the stuff in our state and others. It's in countries that do not incentivize people to buy and improve assets. It shows it's run down. And a lot of, I think over the last few years, a lot of the infrastructure falling apart and problems that we've had has been due to a capital issue, government allocation of funds, obviously, but also as that accelerated depreciation is lowered, you're not getting the bangs for your buck. So then money moves to go somewhere else. You don't want that. You want the money to be improving properties, making communities look good and better.
Yeah, you
instead
want
of them
investment.
pulling it out and going and spending it.
No, you want that investment in your communities and keeping that money there. Like you said, I mean, you started it off fantastic there, talking about having those incentives to keep that going. Have that investment in those communities, in those areas, in those industries, from the private sector, because we all know the government sucks at everything they do. And you touched on
who's in charge.
Capital allocation. Exactly, dude. And no, the private sector does it a million times better every time.
And that's with this property, we get that depreciation up front. I mean, but as we showed, the amount of money that we're putting into this property to expand it and to improve it is more than the cost of the property almost.
Yeah.
So we're just the expansion is 2.3, right?
Yep.
In construction, just that. So we're improving the asset. We're adding climate controlled buildings. We are improving everything from security to fencing to it's safer, it's nicer. That allows property values, branding to go up. It's a better run business, which improves the community. Those are things we want. So we want to be encouraged to do the strategy, and we want others to be encouraged to do it, to buy properties that are underperforming, haven't been cared for, to buy them up, have tax benefits and incentives to improve those properties and improve the landscape around them. Then we end up moving from a class B to a class A asset, or a class C to a class A asset. I love doing that. I love that improvement process. And we look back after 2 years going, this is unrecognizable. I mean, Hayden, perfect example. Unrecognizable. It was
crazy.
A dump.
And dude,
when
the
we
office,
bought it.
like, dude.
Oh, we tore it down. It was just the whole entire building.
Yeah.
And then it looks good. So this is a wonderful way to take advantage of the taxes, improve equity, or build equity, get cash flow, and minimize risk from this strategy. So hopefully this guy's helped you walking through the numbers, why we're looking at these deals, what we're thinking about it, and taking an overall approach on a deal like this.
Well, deals right now, buying. I mean, it's you hear it all the time. People are really struggling to raise capital and those different things. And when you find deals like this, when you have those connections that you're like, hey, you know, because you got to prep people, right? Like you should have some investors in your pocket ready to go.
Yes.
When you find deals like this, so you can say, hey, it's go time. And when you're sitting there going through stuff like this, I mean, and there's a lot of people that are going to want to jump on this kind of an opportunity to be able to partner with you on something like this.
If you provide it,
yes.
Capital in the market, everyone needs somewhere to go. We're talking about
just like the people you just talked about. They're like, dude, I'm going to spend all this money in taxes.
Yeah.
Like, I don't want to do that.
I don't want to do that. In the marketplace, there's more capital than there is opportunities. There's $3 trillion of capital right now in money markets. That's not insane. That's just money markets.
That's so crazy.
The capital needs somewhere to go.
Yeah.
There is more capital than there is opportunity. If you provide opportunity to the markets, the capital will come to you because it needs it. So get out there, find those great opportunities, everybody.
Yes.
Hopefully this will help you analyze and break down deals. And let us know in the comments what questions you have so we can answer them, and tell us too what deals you guys are seeing. And we'll see you all at the conference coming up in September. Thanks, everybody.
Thanks, guys.
We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand.